Hey, everybody, it's Jeff McGinnis, CrossCountry Mortgage, and welcome to August. It's been quite the roller coaster this last month, and I want to share a few things with you that's been happening in the interest rate market, and then kind of conclude with kind of the same party line, but we will get to that in due time. So hang tight here as we get to some of the things we want to cover. So today is Rate Watch of August 2023. I want to talk about the Fed rate hikes, inflation continuing to go lower, and share with you a few screenshots with some things to back this up. The Fed decided to unanimously increase rates by 0.25% on July 26th. And they did this because the party line was the growth was moderate in the economy. The jobs creation is robust and inflation remains elevated. Perhaps they're not following the trends of inflation, which tends to be what the Fed hikes are causing, that we'll take a look at here in a moment. So team, as we look at the trends of inflation on CPI, and this is a chart or a table that shows where we have been heading over the last few months. So July's report, which covers June's inflation information or CPI information, the actual was about 4.8. There was a forecast of 5%, so it actually came in under expectations. And just to keep in mind that number last year at this time was almost 6%. So we are definitely trending downward for our inflation numbers, and that should have a positive effect on the bond market and therefore the interest rates. Bonds perform better in lower interest rate environments, and what the Fed hikes are intended to do is put a little halt on the inflation to slow down the economy so that inflation is not as robust. And we can see here the trend is definitely downward. We're not really seeing that in the bond markets, though, although we did have a good run up when the inflation numbers were reported. You can see over the last month, this was right around July 3rd. Today's recording is on August 3rd. Net, we haven't really changed much. And we've had, over the last 3 months, this roller coaster action happening with, you can see the fluctuations and gyrations of this marketplace, but as we continue to see inflation getting lower, we should see better pricing in bonds, meaning this should go up, and we should see a trend in that direction. That being said, we've had these, we really, like I said before, we haven't really lost anything over the last month, which does then speak to a different subject. Why is this happening? Well, recently, the credit in the US was downgraded, and therefore that doesn't really sit well with the bond markets at all. So that's why you're seeing that downward trend in the bond market, which tends to bring rates up. So we've got a little bit of tailwind with the inflation and some headwind with this new credit rating in the US. Tying this together, we still don't have a lot of inventory. So if you're a home purchaser, or you're a real estate professional, or you're a buyer, now is a good time to coach your clients, if you're a real estate professional, that there's a lot of people that are sidelined because they're afraid of higher interest rates. Or maybe truly it's not the right economic time for them. So there's either fear that is personal about interest rates and buying at a relatively higher interest rate, or they're just financially not prepared or ready because of the interest rate and the higher payment. Either way is fine, but you do need to be brave and ready to be able to play in this marketplace. But the good news is, if you are educated and have an understanding of the marketplace on interest rates, as well as are prepared to absorb those costs, then it's a great time to buy, because a lot of the short supply of real estate is not as sought after by a lot of buyers that are ready and brave, right? So we have the opportunity to coach those who are ready to get into the marketplace and buy while others are sidelined due to interest rates. So it's really a great time to consider buying if both of those things exist. If we think about it, if rates come down to about 5%, which is the market prediction, a lot of experts are saying that, and I tend to believe that as well, there's going to be a lot of buyers that come out of the woodwork, and they're going to compete for a limited amount of inventory. And I've talked to some industry experts recently that also say at rates of 5%, they're going to have a lot more inventory of listings, and they're getting prepared to have those conversations with sellers of property. Now, there's going to be a lag, right? There's going to be a lag between buyers that can immediately buy when the rates are a lot lower, and sellers that need to prepare their properties for sale at lower interest rates. So it's going to be potentially a bit of a bloodbath when rates start to come down. So point being is, now is a great time to buy, provided that those two things exist. You've got the stomach for it, or the understanding behind some of these numbers, and you've got the pocketbook to be able to manage it as well. Now, if you've got some concerns for yourself, or you've got a neighbor that is saying, hey, the rates are too high for me to buy, or if you've got some clients that are sitting on the fence and don't know what news article to believe, I am here to help with individual conversations with folks that would like to have a deeper conversation about their experience and their situation and see if it's the right time to buy. So I'm here for those types of folks. Let them know I'm available. Have them call me or text, email. I do have on my website a Calendly link that will allow them to schedule some time with me at their convenience. So for the month of August, thank you for viewing the Rate Watch report. I really super duper appreciate it. And if you like this video, please give it a like. If you like to be aware of some additional things that are going on during the month, then subscribe to my channel. I encourage you to do that, and have a great one, and I'll talk with you soon.